Journal 3 and 4 gives effect to the unrealized profit in opening inventories. How do we know that there's an unrealized profit in opening inventories? The additional information told us that S Limited, being the buying entity, had intra-group inventories on hand at the end of 20X10 to the amount of 4,400 Rand. So at the end of 20X10, there was an unrealized profit in closing inventories. That then transfers to being an unrealized profit in opening inventories in 20X11. What do we want to achieve? The profit made by P on these inventory sales is now included in the retained earnings balance, opening balance of P, and we have to eliminate it from that account. We also want to bring the profit that was unrealized in 20X10 back into the consolidated financial statements in 20X11. The inventories have been sold, so we do not want to change any inventory balances. But first of all, we need to calculate this unrealized profit portion. The given information told me that an amount of 4,400 was still on hand. That represents the cost price of the inventories for S, the buying entity. It represents the selling price of the same inventories for the selling entity, being P. So to get to the profit included in the 4,400, I need to apply the selling entity's profit markup percentage, which was 10% on cost price. So I apply the 10 over 110 to the 4,400, and that gives me the unrealized profit amount of 400. So to achieve what I want, I debit my retained earnings opening balance of the parent with the 400. This is where the unrealized profit is currently sitting in my starting point in the trial balance of P. What I want to achieve further is to bring that profit back through a credit journal entry to cost of sales 400. Please note it's the selling entity's cost of sales that I'm using to bring that profit back into the group. It was unrealized at the end of 20X10. It has realized in 20X11 because the inventories have now been sold to a party outside of the group. You will note that the journal entry was split in two, so that you first also adjust the opening inventories like you did the closing inventories in 20X10, but you cannot leave that credit entry to inventories that's no longer in the group that has been sold, so you need an immediate contra to inventories for the same amount so that it has no effect. Ultimately, the net effect of Journal 3 and 4 is a debit to the retained earnings opening balance of the selling entity and a credit to the cost of sales of the selling entity. We achieve moving that unrealized profit out of the retained earnings into the profit of the group. Journal 5 looks at the unrealized profit in closing inventories at the end of 20X11. How did I know that there was an unrealized profit in closing inventories? The additional information said that in the separate financial statements of S, there was inventories to the amount of 6,600 Rand still on hand that was purchased from P Limited. That means it's not moved out of the group yet at the end of 20X11. The profit that P made on selling those inventories to S is still unrealized for the group. How do I calculate the unrealized profit included in the 6,600? The 6,600 represents the cost price for S, the selling price for P. So I have to apply the markup that P applies the selling entity to get to the unrealized profit amount of 600 Rand. What do I want to achieve? I want to reduce the gross profit of the group and the inventories of the buying entity is overstated. I debit cost of sales of the selling entity being the parent, and I credit the inventories of the buying entity with this unrealized profit amount of 600 Rand.